I want you to think of this as a homeowner's insurance 101, and it's important because unless you've been completely shut off from the world for a while, there have been and are events happening across the country that involve huge losses for homeowners and interesting tactics by insurance companies. So you'll want to pay attention if you own a home. I'm going to show you how your homeowner's insurance is structured, where you have opportunities to save money, and some mistakes to avoid. Now, homeowner's insurance is quite different from nearly every other insurance product you may have because the cost to have it can be more difficult to keep track of due to how the payment of it is structured. For most, your homeowner's insurance costs are taken out of an escrow account managed by your home's mortgage lender. This means that the costs are bundled into your monthly mortgage payments on your house rather than some standalone monthly or semi-annual bill that you would pay like your auto insurance as an example. And if you haven't checked yours in a while, you may want to because there have been significant increases across various parts of the country over the last year or two, and enough so to make news headlines. Now, the most common cause of frustration and negative experiences with any product or service, but especially with insurance, is the gap between what we, the people needing it, expect and the realities of how these policies actually work. The bigger the gap, the more frustration we have. So if you know how this is all put together, you'll better understand how to make your homeowner's policy be what you're expecting it to be. And at its most basic level, these policies typically protect against what are called perils, which is a very depressing word, but it fits here because these perils can cause significant financial damage to you and your home. For example, the perils of fire, wind, hail, theft, vandalism, and sudden and accidental loss of water are generally what is being put into place with these policies. And yes, these perils have financial issues, but they can also have psychological and emotional trauma attached to them, which is why hopefully the financial side of these problems can be lessened with these plans. Now, the standard homeowner's policy has 6 primary coverages, and then you can add on things that are called endorsements to get an even broader scope of coverage for other things. Endorsements are kind of like an a la carte option to pick more coverage for specific things that you may want, which we'll go over in this video. For example, most insurance companies do not include ground movement, think earthquakes, as an example, and outside water intrusion, meaning flooding, from the standard home insurance policy. There have recently been significant flooding events, so again, it's important to know these definitions and where they fit in your policy. There are separate insurance offerings for those perils offered on both private and government-run insurance markets if you live in an area where one or both of these are common. Let's go over those 6 primary coverages included in the standard homeowner's plan, and they each have letters rather than numbers. Starting with coverage A, this is the primary protection for the actual structure of your home and any attached porches, patios, or garages. Attached is the key word there. Coverage A pays for the repair or the rebuilding of the home in the event of a covered loss. I'm going to go over the 3 different types of homeowners insurance after we get through these coverages, and that definition of covered loss is important. Without coverage A, you would be responsible for the full cost of repairing or rebuilding your home out of pocket, which that could be financially devastating and unrealistic for most people. Coverage A is also used as the basis for several of the different upcoming coverages included in your policy. So underinsuring on coverage A can lead to problematic limits across the other parts of your policy. The limit of coverage A should reflect the full reconstruction cost of the home, and that is not the full market value. So let's say that you could sell your house for $500,000. That is the full market value. That is not where you're setting your reconstruction costs for the home. It would be less than that because if you were selling your home, part of that cost includes the actual land that your house is built on. Instead, insurance companies look at a few things to calculate the reconstruction cost of your home: the total square footage, construction costs per square foot, home features and materials, the construction type and style, the year your home was originally built, and any updates and attached structures. There's that attached word again. And it matters because now we're ready to move on to coverage B. Coverage B focuses on other structures, specifically detached structures on your property like garages, sheds, and fences. This can also include hardscapes like sidewalks, driveways, and pools. Accessory dwelling units, or ADUs, are secondary residential units on the same property as a primary dwelling. These are sometimes referred to as a granny flat or a mother-in-law suite. ADUs can be attached to, detached from, or within the existing structure of the main house. ADUs can also be covered under separate structures and are valued at a percentage of that coverage A, and that percentage is typically 10%. Next is coverage C, and this deals with personal property. So this would be for belongings that are inside the home that are not permanently attached to the structure of the home itself. So personal property limits are calculated as a percentage of coverage A again, and the percentage is going to be different based on where you are and the insurance company that you pick. Personal property coverage is worldwide, meaning that it can cover theft while traveling, but the insurance companies will limit how much they are willing to cover off the premises of your home. Personal property is limited to the perils of the policy you get, which we discussed in coverage A, so fire, wind, hail, theft, vandalism, and the sudden and accidental loss of water. These perils do not include you or someone else accidentally breaking your personal property or you or someone else losing your stuff. If you have high-cost items that could be easily broken or lost, like art or jewelry as examples, you can buy what's called an additional personal articles floater, but that is not included in the standard homeowners policy that we're talking about right now. All right, we are on to coverage D, which is loss of use. This is additional living expenses if you could not live in your home because of a covered loss. It is meant to make sure that you can maintain your standard of living while your home is being rebuilt or repaired because of those covered losses. These additional living expenses could include the costs of a hotel or a temporary place to stay, increased meal expenses, costs to board your pets, additional transportation costs, laundry or storage costs, and moving costs, or there are others. It is only meant to cover the additional expenses resulting from the loss, not the regular costs that you would incur anyways, like the cost of usual groceries, travel, or mortgage payments. It is the amount extra because of what you're going through with your home being reconstructed or rebuilt. And like the others that we've talked about, this coverage only applies to the covered perils on your policy. Excluded perils like flooding or earthquakes are not covered by coverage D. Next is coverage E, and this is personal liability. So this covers bodily injury or property damage when you, the homeowner, are considered negligent. This can include slip and falls, falling objects, assault, battery, injury caused by animals, pool drownings, water or fire loss that damages neighboring properties, and others. Standard limits for coverage D range from $100,000 to $500,000. You can buy more coverage through what's referred to as a personal umbrella policy. As a homeowner, you would want to carry enough here in coverage E as it covers your legal liability, protecting you against lawsuits resulting from injury or damage away from the home. It covers property damage to other people's property, provides legal defense, and preserves your assets. Similarly, coverage E helps in paying for legal defense costs, settlements, court judgments, and repairs or replacements for the damage of others' property. Without personal liability, you could risk having to pay liability claims out of your own pocket, risking your savings, home equity, and future earnings. Okay, the last coverage letter would be coverage F, which is medical payments to others. This covers direct medical expenses in the event of someone getting hurt on your property. Unlike personal liability, you do not need to be deemed negligent for medical payments to be paid out. Medical payments are a set limit per person ranging from $1,000 up to $25,000. So those are the 6 different coverages that you'll find within standard homeowners policies. There is one more important definition to cover, and then those 3 different ways that these policies are set up that are extremely important to you because it impacts what is and what is not covered. But first, that important definition is the deductible. A deductible is your shared part in this risk. In the event of a covered property loss happening, the deductible is the dollar amount that you are responsible to pay first. It is highly recommended that you carry the highest deductible you can comfortably afford if and when a loss happens, because this is one of the factors that impacts your insurance premium costs. I'll get to that here shortly. Deductibles for homeowners insurance can be either a set dollar amount like $1,000 or $10,000 or whatever your level would be, or deductibles can be a percentage of that coverage A limit that keeps coming into play. So it could be 1% or 2% or 5% of that coverage A limit you set on your plan. The higher you set your deductible, typically the lower your annual premiums will be to have this plan. Okay, if you've made it this far, you now know probably more than you wanted to about your homeowner's insurance policy, and we're almost done in making you an expert. But first, you need to know the 3 most common homeowner insurance policy structures, what goes into the cost of your policy, and how to save money. The 3 most common homeowners policies are referred to as HO5, HO3, and DP3. HO5 policies are the most comprehensive of the three. Both the dwelling and the personal property are covered on an open perils basis, and this is important. This means that it covers all risks unless something is specifically excluded. Think of HO5 as everything but policies because they cover everything but specifically mentioned exclusions. HO5 policies have fewer exclusions and higher limits for property like electronics, jewelry, and others. This policy type is ideal for newer, high-value homes or homeowners with more valuable belongings. Next are the HO3 policies that are the most common type for owner-occupied homes. The dwelling is covered for open perils, so all risks unless specifically excluded. The difference comes in personal property, which is covered for named perils only, such as fire, theft, and vandalism. HO3 policies are good for the average homeowners who want solid, customizable protection. So the difference here would be in that personal property side, potentially less protection for personal property items. The last of the three major policy types would be DP3 policies. These are referred to as dwelling fire policies or special dwelling policies meant for non-owner occupied homes, like rental properties as an example. This policy type is great for landlords who don't live in the home. DP3 policies cover the dwelling on the open perils basis, but personal property is often limited to the landlord-owned items, like the appliances, again as an example. It normally includes loss of rent coverage at fair rental value. Personal liability and contents coverage are not normally included, but they can be added via endorsements, which are those extra add-ons that we talked about at the beginning. It is in the landlord's and the renter's best interest that the renter carry their own renter's policy to protect the renter's personal property and the renter's liability exposure, which introduces a fourth policy type. I'll just mention it here, and that is the HO4. Renter's insurance policies are on HO4 forms and work very similarly to the HO3 policies, except they do not include any building coverage since the renter doesn't own the home or the building or the structure. Okay, let's talk about these policies' costs, or more specifically, what goes into these costs, and then how you can save some money. There are several factors that go into the pricing of a homeowner's insurance policy, such as the location. For example, if your home is in a high-risk area for wildfires, severe thunderstorms, high winds, and freezing temperatures, your policy may cost more or have exclusions. Other factors would include the age of your home or the structure, the type of construction, whether you have a history of homeowners insurance claims, and the amount of coverage purchased. Meaning, remember how a lot of the coverage letters are based on coverage A? So raising your coverage limits will raise your plan's costs. So this is where your savings and tips come in. We've talked about a few levers that you can pull here to help with your costs, like that deductible. So setting a higher deductible will generally lower your annual homeowners insurance costs. Your coverage A limits will impact other costs. Where you live matters, and knowing what risks you're moving into is important. There are many ways to get discounts on your homeowner's policy. So for example, bundling multiple lines or types of insurance coverage together. You see this all the time in the commercials. But for example, you could combine your home insurance with your auto insurance with the same insurance company, and that insurance company offers discounts. Discounts may be offered for specific college degrees or professions, security systems, smoke detectors, new roofs, and having a history of no claims can also make discounts eligible. Make sure you do annual maintenance on your home, so keeping your gutters clean, inspecting your roof, and keeping a video, photographs, or a log of personal belongings. This can be very helpful in the event of a fire to catalog what has been lost. There are home inventory apps available for you to download, or probably the best method is to just use your phone to record your items. Walk around your house and say, I bought this while in Europe in 2023 for $4,000, and narrate your expensive items, when you got them, and how much they were. Many policies will include additional coverage options like an inflation guard and building or ordinance endorsements to cover the additional cost difference for bringing a home up to current code. Now, admittedly, I'm a Medicare nerd, and I'm trying to make the world of insurance as easy to navigate as possible for anyone who has taken the time to watch these videos. I'm not saying I agree with or that I like the insurance system. I'm just trying to help you work within that system that exists already to better take advantage of it. It is best to review your insurance policy at least annually with a trusted, independent insurance agent to make sure that the policy still accurately protects your assets. I prefer independent agents because they represent several different insurance companies rather than one selling just one insurance company. Now, there are independent agents that, again, can represent several, or they're what are called captive agents that only represent one insurance company. So they can't offer you other companies. It's just the one that they represent. So there is a little bit of bias that goes into that. Sometimes the captive insurance companies are the right fit for you. Sometimes they're not. And so to have an independent agent that can shop that around, I highly recommend that for you. Every insurance company has strengths and weaknesses and works better or worse even in certain areas of the country. So even if it's not reaching out to us for help with this, or if you already have an independent agent, please use them. They can help answer your questions and they can shop the different plans. They can do the heavy lifting for setting up all of these plans and coordinating with your mortgage and your escrow companies and assist you if you do need to file a claim because of an incident. Now, I'm excited to announce that I have established a partnership with the largest private and independent homeowners and auto insurance group in the country, representing more insurance companies in more areas of the country than anyone else. And I'm excited for it because we get people who reach out for Medicare, Social Security help, estate planning, financial planning, and then this comes up. And so before now, I haven't had somebody that I could trust and refer them to help with this, and now I do. So if any of you want to reach out, if you've noticed that your home insurance has gone up, which in most areas of the country, these rates have gone up considerably, or your auto insurance rates have gone up, or you're just curious to know if what you're paying is remotely competitive with the other companies out there, there is a link in the description of this video to my home and auto partners that can shop the different plans with different companies for you. Now, I leave secret code words at the end of my videos to help me with comment management. I remember watching the movie Twister as a kid and being absolutely terrified of tornadoes. So if you leave the word or the emoji of a twister or a tornado in your comment, then I'll know that you've made it at least this far and I can take those comments a little bit more seriously. Your next video to watch is right here. I appreciate you watching and I will see you over there.